Welcome to everybody. It's our first umbrella fund survey, and as I'm aware, the first sort of larger scale national survey that has been done on the larger umbrella funds in the country. And yeah, welcome to that. I've got a few guests that I'll introduce you to just now that will go through the body of the presentation and the main findings of the survey. But before I do that, just a few words of thanks. A survey like this takes a while to do, and I want to firstly say thank you to everybody that participated in the survey, providing data and sharing your information so that we can get a good picture of what is happening in umbrella funds in the country. Also, just then internally from our side, the person who did the most of the heavy lifting for this has been Gia Millet. Gia, thanks for your hard work on this, and Willie and the team. So thanks for putting this together. I'm trusting that this is something that will be useful for the pensions industry and for funds and players in the industry. The survey covers a few areas, and I'm privileged to have a few of my colleagues and fellow actuaries to help present with me. I've got firstly Gerard Meiberg will be talking about the demographics of the fund and what's happening there. Gunnar Hermans will be talking about the various governance issues that we investigated. And then Manja will take us, Manja Serfontein is an actuary that will be talking to us about the administration. Colin Hendricks will be talking about investments and the different aspects that we found there. And finally, Gia Millet will be talking about the cost comparison, which is something that I think we all be very interested in, because that is something that's fairly new. I haven't seen major investigations about that before. So just briefly about the format of the presentation. It will be for 1 hour maximum, so we won't take it too long. All of the detail that will be discussed in the presentation will be part of the survey that will be available on the website. The survey will be released directly after this presentation at around about 12, and you can find that on the website. We will also be emailing all the people who participated in the survey a direct email with a personalization so that you can see which of the various aspects your fund is highlighted in. We made the survey anonymous so that you don't see which fund is which, but to the participants, they will be able to see their own fund at least and how they compare. After the presentation, we'll have a question and answer session. So you're free to or welcome to post your questions in the chat function, and afterwards we'll go through those. If we don't have time for all of that, we'll get back to you with sort of comments, but hopefully the survey will answer a lot of those. The full document will be available then. Another major thing, this is our first attempt to do something like this. And if you've got any suggestions as to how to improve it, how we can do things better, both in terms of obtaining the data and presenting areas to cover, please also email us with those suggestions. The email address to use would be at the end of the presentation. So you can contact us there or any of the people that you interacted with during the course of providing data. So just a few words on the survey in general. We had a look at a few aspects, well, the questions that we want to answer. I think always good to go through the who, where, what, when, and so forth. But the question is, why do we do another survey? To me, the main thing was that, there's a big thrust to move funds into umbrella funds. Some of us may agree, some may not. But the reality is there's a lot of funds that are transferring and moving into umbrella arrangements. There's not really a good place to see how these funds compare. And the purpose of our survey is to just give a snapshot of what is available in the industry. Firstly, how does it compare just demographically? how many members, how big are the funds, but then also digging a bit deeper into the governance issues, some administration aspects. There's communication with the fund, investment, and we know umbrellas are often built to be a one-size-fits-all with many bells and whistles that can be attached at cost sometime. But still, even though it's a difficult thing to compare, we thought let's take a stab at it and try and give some sort of overview of what is available in the country. Another thing that prompted us to do the survey now is the ASISA standard that came out and has been implemented sort of in the two levels on costs. So the two cost sets on the fund, on the general fund level, and also then on the participating employer fund level, those cost comparisons on a standardized basis, I would think allows us the opportunity to compare funds sort of in a like-for-like manner. There's many things that will still change, but we try to find a way to at least get some cost comparisons out there, and I believe that would be useful to the industry as a whole and every individual provider as well. So we're hoping that this becomes a useful resource over time, and as I said, we'd appreciate your suggestions as to how we can improve. Then on which funds were included, we had a look at the funds, and here if you can take the next one, we took the largest funds that had 50 participating employers as a minimum, so there needed to be at least 50 participating employers and 500 members in the fund as a whole. So if we use that, we cover a large part of the umbrella fund providers in the country. On the slide, you can see the administrators that were involved and also the funds that are mentioned. With the latest legislative changes, the borders between pension and provident funds have become blurred. So we're expecting those funds to merge over time. For the survey, we included both the pension and the provident fund and compared those as all of these funds as best we could. We used open funds that are open to the general public, and so we excluded industry-specific funds, so that this survey could be used by potential or employers looking to potentially move to a fund to see how the funds compare as a whole. And then as to what was compared, I mentioned the topics that will be covered by my colleagues. We looked at the demographics, governance, administration, investments, and costs. So I'll not say more about that, and that will be covered by each of the presenters just now, and that also is a different section in the survey that will be available on the website afterwards. So that's all that I have to say, except that I hope that you find this useful, and that next speaker will be Gerard Meiberg, who will be taking us through the demographics section of the survey. Thanks, Gerard.
Thanks, Tommy. If you can move to the next slide. Thanks, Gia. Yeah, so a lot has been said of late about umbrella funds taking over the retirement fund space, but do they really dominate this space at this stage? As part of my part of the survey, I looked at the numbers and tried to come up with the answer to this question. What we found that the answer is yes and no, because a large part of the umbrella funds in the market is still private umbrella funds. So that's more your industry specific or your union type funds. And together with standalone funds, these two still represent the greatest portion of the market, about 76%. Whereas commercial umbrella funds cover about a quarter of the market. Now, it would have been interesting to see what this looked like 5 years ago compared to now, and how this will change over the next few years. Thanks, Gia. So first of all, let's dive into the demographics in terms of assets and membership. What we found is that the market is dominated by 5 providers. And together they cover about 85% of the total membership in commercial umbrella funds. So this is based on information that we received that we got of the FSCA database of funds. And as you can see in the graph there, with the top 5 or the big 5 commercial funds to the left, the rest of the funds really pale in comparison to those big 5. Next slide, please. And as you'd expect, this trend continues when looking at participating employers as well, where the greatest number of participating employers are also found within the big 5. As you can see in the graph to the right, the bar graph, where one of the big 5 was excluded because it didn't participate in the survey. But as you can see, quite a lot, with the biggest number of participating employers also found within these 5 commercial umbrella funds. Next slide, please. And so as you'd expect with the membership and looking the way it is, and contributions and membership being correlated, we also found that there's a big variation between the contributions received by the big 5, which we found to be an average of about 660 million rand per month flowing into the big 5, compared to only 60 million flowing into the other smaller funds. But what was interesting to note is the ratio of assets to contributions, and that this ratio was fairly stable across all the funds considered. So a low ratio could either imply a low asset base, like in the case of a fairly newly established fund, or it could be a fast-growing fund where your contributions by far outweigh the current asset base. And although there's several factors that could impact on this ratio, this does, however, appear to show that there's none of the small or new umbrella funds that are really gaining a significant market share at this time. So in the end, the key question was, is bigger better? People, as we can see in the membership, participating employers are often want to join some of the big corporates, some of the well-known sponsors. But so what we did was to consider all of the factors that are discussed in more detail separately in the survey, but to look at how this compares to fund size. So first of all, in terms of governance, we found that there was no discernible difference between the number of trustees and independent trustees appointed to large or smaller funds. Also, in terms of fidelity cover, this appeared to be related to fund size, and none of the funds appeared to be underinsured. Also, in terms of actuarial overview, we found that it was the bigger funds that are generally valuation exempt. And in fact, it's the smaller funds that have actuarial valuations performed by independent actuaries as an external check on the fund's operations and administration. In terms of administration, we also found that there was no notable difference in the services offered, and furthermore in the fee structures. So the way fees are charged was basically a fixed fee per member or percentage of salary, or a mix of both, and no correlation in the manner which fees are charged between big and small funds. So the differentiating factor would be the quality of services offered, which may be subjective. In looking at investments, again, no differences found. All of them offered life staging investment strategies, as well as individual member investment choices. as a counter to what you'd expect, the smaller funds offer the same variety of asset managers and portfolios. But what we did see was that where there are fund sponsors that has its own investment management division or subsidiaries, their investment offering may be geared towards their own interests, and also the default portfolio may be an in-house portfolio. And so one has to decide if that portfolio is up to par with that available in the market. And the same goes for insured benefits, where most allow for a selection of insurers, but where there's an in-house offering or where the sponsor is linked to a life insurer, the offering may be geared towards those products, and one has to decide if those rates, risk premium rates, will remain competitive. So just in conclusion on demographics, we found that on paper at least, there's no discernible difference between the small and larger funds, but that one, especially in the one-stop shop funds, one needs to be aware of the potential conflicts of interests. And so in the end, one has to decide which provider will be able to meet all of your specific needs, provide good service, and do this in the most cost-efficient manner. Thank you. And with that, I'll hand over to Corneille Heymans, who will guide you through the governance aspects. Corneille, you're on mute. Sorry.
There's always one. It had to be me this time. Thank you, Gerard. I'm going to talk about governance and how a new participating employer should go about choosing a fund that suits his needs best. Yes, surprisingly, it is about style and preference, more so than the underlying governance structures, because the funds generally have similar structures, similar outcomes, even though the structures may differ. So I'm going to introduce you to two potential participating employers who now has to go to market and choose their participating employer, their umbrella that they want to participate in. On the left, we have Herr Heinz. He's a real dictator-style manager. He's a micromanager of note, and he likes to have full control of every single aspect of his fund. On the right hand, we have Flo, who's very much everything that Herr Heinz is not. He believes that if you surround yourself with good people and you generally do good things, then good things will happen to you. So he pretty much leaves the running of his business to karma. And surprisingly, both of these are equally successful in their business, but they will have clearly different needs in selecting their preferred umbrella provider. Now, if I can go to the next slide, please. I'm not going to go through the detail. The point to note here is that pension fund industry and umbrellas in particular, it's a very regulated environment. You've got acts and regulations, and pension funds adjudicator, and even the courts get involved in running these funds. That's why we haven't seen any real corporate failures or fund failures in the past, because it's so highly regulated. And that's why in the end it becomes a matter of style and preference. Which fund will give you as an employer the best night's sleep? What kind of style of management would you prefer? Now, clearly, Flo doesn't really care about all this governance nonsense, while Herr Heinz loves all the bureaucracy. He believes that puts him in a very safe space. Flo just wants someone to take responsibility for it, as long as it's not him. So on to the next one. How do the different funds go about this? If we can go to the next slide, please. There we go. The Board of Trustees is responsible for the running of the fund. They go about their business in different ways, but all under the same rules and regulations. On the one hand, you could get a Board of Trustees that's completely autonomous, professional Board of Trustees. They do their own thing and nobody needs to almost know about it. They just do what needs to be done. Music to Flo's ears. On the other hand, you get a board that operates through a very active management committee, where the management committee almost acts like a mini Board of Trustees. Now, to some extent, that defeats the purpose of freeing up management time from doing administrative business and governance business. And the other downside of that is the management committee actually doesn't have any real powers. They can influence the trustees' decision by giving information, but the buck stops with the trustees. The management committee doesn't have any real power. So it may be a perceived benefit, and there may be some real benefits in it, but as with everything, there's pros and cons to both approaches. Another differentiating factor is how big is the Board of Trustees. Again, various pros and cons to either, and I'm not going to go through that. That is in the survey set out in more detail. What I would like to talk about is the independence or the perceived conflicts that sits with having independent or sponsor appointed trustees. Now, it does come at a cost to have independent professional trustees, but I'll talk about that a bit later. The cost is not prohibitive. So let's take that out of the equation for the moment. The perceived conflict of interest is the important one in my mind. Yes, if the trustee is paid by the sponsor to make certain decisions, is he going to be biased and not necessarily make the right decisions for his members? I don't think so. Maybe naively so, but a trustee member has a fiduciary and legal duty to his members. And I would put a much higher price on that than on my employer trying to bully me to do something. And having said that, the employers will generally also not try to bully their trustees into anything because it's just not good business if that should come out into the open. So I'm hoping that the checks and balances in the governance structures should allow even a sponsor-appointed trustee to do a decent job. But as I say, different strokes for different folks. You may put a big value on having professional independent trustees, even if it does come at a cost. So in conclusion, on the next slide, what it comes down to is that the buck always stops with the trustees. As participating employer, you don't really need to be so bothered about how they get to their decisions, as long as they accept and acknowledge their professional and fiduciary duties. So what did the survey show us? On to the next slide, we can see the results of the survey on the number of trustees on the left-hand side. Half the funds that we surveyed has the minimum number of 4 trustees, and all of them 2 employer or sponsor appointed and 2 of them professional trustees. The other half ranges all the way to having 12 or even 14 trustees on a board, and you'll see the range of professional versus sponsor appointed trustees on the right-hand side is all over the place. Again, as I said, it's a matter of choice, which type of board will suit you best or your employer best. The next topic is about statutory reporting. Audited financial statements, it's neither here nor there, it has to be done. How the participating employer makes use of that information is where it differs, and that's not something we need to go into here. The important one for me is whether or not a fund opts to have statutory valuations or opts for valuation exemption. Again, pros and cons both ways. The one comes at a cost, but it does give an extra layer of oversight or review. And taking it to the FSCA to review the valuator's work is another layer of oversight, which again, for our participating employer, Herr Heist, it is a beautiful thing to have so many people making sure that all the T's are crossed and all the I's are dotted. But from Flo's point of view, is that not a duplication of the auditor's work? Is it really cost effective? Is it really necessary? If you fully trust your administrator and fully trust the auditors having done a proper job, why do you need a valuator looking at it as well? And again, if you do go for valuations, the question of independence comes up again. Do you appoint an independent valuator or do you use an in-house valuator? Exactly the same arguments go here. And maybe one extra layer in defense of the sponsor-appointed valuators is you as valuator has a professional duty to act within certain standards and rules and regulations. So independent or in-house, I'm hoping that most actuaries will live up to their professional code and do the right thing. But knowing that someone is independent does give that extra layer of comfort. So now the question, is there maybe best of both worlds of having a non-statutory actuarial review? So you don't go for full valuation exemption, but you do perform annual or triannual statutory actuarial valuations. In doing that, you get the best of both worlds by getting an actuary review the work, but also you don't need to go through the bureaucracy that's associated with it. To take it to the extreme, you could even ask a valuator to do a PE level actuarial valuation. That's just a thought. We're not going to go into that. Let's see how different funds currently operate in this field. Top left-hand side, statutory triennial valuations. About a third of funds do have statutory valuations and 2/3 don't. And then in the circle graph, you can see that it's a nice split of 1/3, 1/3, 1/3 almost, where if you don't have statutory valuations, a third of the others do have interim valuations. So you can see it's a nice split between those who opt to have valuations, those who opt not to have valuations at all, and those who opt to have statutory valuations. Again, it comes down to style or preference. If the one was clearly better than the other, I think we would have seen a much clearer split between the different categories. Okay, on to the next item or topic is fidelity cover. That is the tricky one because it's very difficult to compare. You need to go into a whole lot of detail on exclusions, etc., etc. More cover is generally seen as better, but it costs more. A big component to look at here is the sponsor's liability. If you have a sponsor with deep pockets, then it might be okay to have less cover, but that's an open-ended question. So on to the next slide. What's the conclusion? There's no simple answer on this one. The employer should just ask the question, what does your fund have in place and how do they expect to meet losses if the worst comes to worst? We can see from the level of cover that it ranges all the way from 1% of assets to 30% of assets. Now that will again be a function of how deep the pockets of the sponsors are. So in summary, minimum governance should generally be met. So there's no realistic chance of a major failure. So I don't think any employer should ever lose sleep about the governance. The regulator, I think, is doing a fairly good job at looking at all these things. As I mentioned, cost of governance is much less of a factor in the bigger scheme of things than one might think. So pick a fund that suits your style and preference and don't let costs be a deterring factor. You can't turn a blind eye to costs, obviously, but in the bigger scheme of things, looking at admin fees and all the rest of it, one extra trustee is not going to cost that much more if that's something that you have a preference for. In my mind, administrative red flags is the best possible proxy for good or bad governance. Regardless of how many trustees you have, how many of them are independent or otherwise, if the admin starts falling flat, governance starts falling flat. And if you see administrative red flags, I say that's when you have to start thinking about let your money do the talking, stop all the different investigations and go to a place that gives proper administration, because that is tangible. Governance is not as tangible, and I'm saying you can probably rely on the authority to do his job. So on my final slide, it's a matter of preference and style, and both Flo and Heinz had a comfortable retirement at the end of the day. Both of them slept easy, having picked completely different umbrella funds, but because it met their standards and their requirements, it worked for them. So speak to your participating employers, understand their needs, then understand the different funds that you want to recommend them to go to or that you want to go to, and pick according to your own preferences. Okay, so that's all about governance, and now on to the very important aspect of administration, which I think forms a core part of governance in itself. Manya, over to you.
Thank you, Corné. I will be taking you through some of the administrative features that we investigated in the survey. Umbrella funds offer a plug-and-play solution to employers wanting to provide retirement benefits to its employees. Simply choose a fund, set up your employee data, and select the contribution rates, investment options, risk benefits, etc. Pay and submit your monthly contributions. However, how do you choose the right fund? To reduce the intimidation factor of technical terms and fancy marketing techniques, we have compared choosing an appropriate umbrella fund with buying a new tech device, in this case, a wireless speaker. Next slide, please. When buying a wireless speaker, a quick online search will produce countless results from which you can establish what features are non-negotiable and which ones are nice to have. As an employer, how do you know which features in an umbrella fund is non-negotiable must-have features and which ones are costly nice-to-haves? This part of the survey aims to highlight the key administrative features that should be considered when choosing an umbrella fund. Firstly, we look at the admission criteria. Most umbrella funds have a minimum member requirement per participating employer, and this will therefore form the first eliminating criteria when selecting an umbrella fund. The criteria for most funds are quite low, with 36% having no minimum, and the bulk of the participating funds having a minimum of less than 10 members. The next feature is administrative fees. Funds have different fee charging structures, with the most prevalent either a fixed fee per member or a percentage of pensionable salaries, making up about 29% and 43% respectively of the respondents in the survey. As an employer, you will have to consider the nature of your workforce, taking into account the impact of the charging structure on a small salary earner versus a large salary earner, and considering the possible cross subsidies inherent in the different charging structures. Next slide, please. The next feature to consider is the option to choose the rate at which you and or your employees will contribute. People have varying degrees of ability to save towards retirement and also different retirement saving goals. That being said, all respondents in the survey offers contribution choice, and it is therefore not a distinguishable feature. Retirement benefits offered by funds is another key feature to consider. Retirement benefits are mostly defined contribution in nature and similar across all umbrella funds. This will therefore not set one fund above another. However, default regulations that came into effect on 1 September 2017 requires funds to have default options regarding investment choice preservation and annuity strategies at retirement. It is therefore important to ensure that the default option provided by a fund are suitable to your employees' needs. Of these default options, we focus on the annuity options at retirement. Most funds offer only externally insured annuity options, whereas about 29% offers in-fund living annuities and 14% in-fund living or guaranteed annuities. In terms of familiarity and continuity, it could be argued that a fund annuity are a valuable option. Okay, so flexibility is the next feature to consider. Flexibility is offered in a range of different aspects, from contribution rates, investment products, risk benefits, insurers, etc. However, one must always keep in mind that flexibility comes with a price. The more flexibility offered by a fund, the more likely it will be that the administration and investment charges will be higher. So be sure that you don't pay extra for cool features that you don't need. The last feature that we would like to highlight is communication with members. In today's day and age, technology has become a way of life, even for the older generation, or at least those who are willing to embrace change. There are various ways funds communicate to their members. The majority of umbrella funds, 71%, have a web portal as well as a mobile app, with some 29% that only have a web portal. There are far more people in South Africa with access to smartphones than access to a computer. A mobile app, in addition to a web portal, is, in my opinion, a big advantage, but will again depend on the nature of your workforce and the associated costs. I'm one of those people who want it all and I want it now. You therefore also need to consider the extent of the functionalities offered by the web portal or mobile app, as well as the frequency with which the information is updated. The survey didn't look at the range of functionalities, but it's something that could be included in the future. Consider the frequency at which information is updated. Most umbrella funds are unitized daily, and updated benefit information should therefore also be available daily, which is the case for 57% of the respondents. In my opinion, daily updates do not add much value and poses a real risk that members might have knee-jerk reactions to market movements and consequently make rash decisions that could have a negative impact on their retirement savings. However, I do feel that updated information must at least be available on a monthly basis. Connecting and charging your device. No one likes to struggle to set up and manage their devices. Pairing your phone with your wireless speaker, setting up your account on the music app, and creating a playlist must be a seamless exercise. Similarly, it is important to compare the initial setup requirements of the funds when making your choice. Furthermore, battery life, charging frequency, and charging time is another important factor to consider when buying a device. As mentioned in the section on governance, some employers may like to have constant involvement in the management of the fund, while others will leave it in the capable hands of the Board of Trustees. The employer will therefore need to make sure that his desired frequency of communication and level of involvement will be accommodated by the fund. And finally, wrapping up, choosing an umbrella fund doesn't have to be intimidating. We When we as laymen buy new tech gear, we research all the key features to consider in such a device, list the features applicable to the products offered by different brands, and then compare to find the one that best suits our needs. Simply follow the same approach using the key features that we have highlighted above, and choosing an umbrella fund becomes easy. After you have completed the initial setup, you can sit back, relax, and enjoy the music. I will now hand over to Colin, who will take you through the investment section of the survey.
Hi, morning everyone. Okay, so I mean, at the risk of restating the obvious, contributions plus investment returns equals your ultimate benefit. So investment returns matters, and they matter just as much in umbrella funds as they do in any other type of retirement fund. One of the key things is at what level can you then elect your investment options? And what we found is that 100% of umbrella funds offer some form of member choice, but interestingly, not all umbrella funds allow that decision to be made at employer level. In other words, next slide, please. One of the things is that a lot of umbrella funds market the number of investment options as a feature of the fund, and to an extent it is. But the risk is if there's too many options, investment options, members and employers get confused and potentially make poor decisions. So if you're in a fund with a lot of investment options, or you're thinking of joining a fund with a lot of investment options, make sure you either have the expertise or you have an advisor available to assist you. So to give you an indication, about roughly a third of umbrella funds offer less than 10 investment options. The majority is sitting somewhere between 11 and 50 investment options portfolios. And then there are some that offer over 100 options, which, I mean, if you're not an investment expert, you might find quite confusing. Generally, employers will then decide what options to make available to the employees belonging to them. Even this can be quite daunting, and a default investment strategy does make this easier. I mean, it is compulsory for all funds to have a default investment strategy. But even with that default investment strategy, we'll get into a bit more detail on that just now, you still need to potentially consider what other options to make available to members. And in doing that, you need to also carefully consider what fees that implies, what extra communication there is, and also the risk that employees or even employers make poor choices. Next. Getting to the default strategy, now this came in a few years ago. All funds, regardless of whether they're umbrella fund or not, must offer a default investment strategy, which basically applies to a member, sort of should be applicable to the, I'll use the word average employee who does not want to or does not feel comfortable making an investment decision. Most umbrella funds, the employer can select a default strategy that applies to its members. But if the employer doesn't want to do so, there's also often a fund level, or there is a fund level default strategy that apply. Interesting, from the survey, looking at the results, the default portfolios target returns of between 4 and 7% above inflation per annum. So depending on which fund it is. And the majority, about roughly 60%, target inflation plus 5%, is as low as inflation plus 4, and it does go up to inflation plus 7. Now, that on its own should not be a decision-making or a factor that influences your decision on which umbrella fund to go with. The important thing just is if you have an umbrella fund that targets a certain return on its default strategy, are there options available that target different returns that members can make use of who might not be comfortable with that default strategy? One of the important things with the default strategy is what does it actually aim to achieve? And typically, what a default investment strategy should do is target a specific type of annuity that provides a retirement income in retirement. So most umbrella funds we've seen from the survey results tend to offer that you either take your capital out of the fund, or alternatively, the most common option is a living annuity in the fund. If that's what the default strategy targets, and you're a member or you're an employer who thinks maybe a with-profit annuity or a guaranteed annuity might be more appropriate, you might have to look at how you tweak that default strategy and what other investment portfolios you would make available to members who do not necessarily want to end up in a living annuity. Generally, in all cases, younger ages, you would have a more balanced fund type approach of quite a high weighting towards equities and property. But as you get closer to retirement, the strategy will start switching into whatever type of annuity you're targeting. And theoretically, if it's a living annuity, you should just have a balanced fund throughout. That's what you typically find as members age. So just to summarize, electing the default investment strategy is almost, in most cases, electing what type of annuity you deem appropriate for members in retirement. So as an employer, you need to think about that. Think of the workforce, what kind of annuity should they be in. And it is important to give employees who do not want to take that kind of annuity at retirement the option to select other investment portfolios. Conclusion, what this survey shows is there's quite a lot of flexibility regarding investment choice to individual employees, and that's across funds. But there are some differences in the number of choices that employees can make. So some of the larger funds offer far more investment options than the smaller funds. And with that, I'll hand over to Gia to talk about costs.
Great, thanks, Colin. Just going to see if my camera is working. I can't see myself, but I assume it should be working. So I'll just highlight the most important points of our cost section. There's a lot more detail in the survey report that you can go through later on. So cost is probably the single most important factor for employers and members of umbrella funds. As Colin said, with investment returns as well, but costs has a direct impact on a member's retirement benefit. But the comparison of fees is a very contentious issue, and it used to be difficult, if not impossible, to make a fair and accurate comparison of costs between service providers. We actually tried to launch this kind of survey a few years ago, but we couldn't get providers to provide us with quotes for an umbrella fund arrangement. But luckily, ASISA came to the rescue with a tool which allows us to compare apples with apples when considering costs. So ASISA is the Association for Savings and Investments South Africa, and RSC is the Retirement Saving Cost Disclosure Standard, and it sets out the minimum disclosure requirements to ensure that members of ASISA show costs in a standardized and comparative manner. So the RSC standard is based on a standard set of assumptions, and the costs are expressed as a percentage of projected assets. It's important to note that this is only done on a participating employer level and not necessarily relevant for individual members. Although it is a useful tool, it doesn't reflect the impact that costs will have on individual members. And there's also a new ASISA standard, the EAC, Effective Annual Cost Disclosure, that should have been implemented from March 2021, and which we will include in further surveys, and that will provide member-level comparisons. So the RSC disclosure is made up of 4 components: the investment management charge, usually the biggest portion of that, and that is basically the total expense ratio plus the transaction costs. Then you have your administration charge, and that is your usual admin fees, and then any investment administration fees not included as part of the investment management charge. The third component is the advice charge, and that is advice, commission, and then once again, investment consulting not included with investments. And then there's the other charges, which is your normal levies, fidelity insurance, PI premiums, actuarial fees, audit fees, communication, etc. So the methodology for our cost section of the survey we received quotes from 12 providers, and we specifically only asked for pension fund quotes. In all the previous sections, the funds gave their bells and whistles, everything that they can offer, even if it comes at an additional cost. But specifically for the quote section, we asked them for their simplest vanilla fund option that will cater for this specific participating employer's needs. We also requested all administration, consulting, advice, and other costs to be payable within the quoted arrangement. We did not allow for any risk benefits. We just want to look at the pure costs of the fund and not the risk costs. Each service provider used its own default investment portfolio, and we provided 2 membership data sets. There's a quote 1, you'll see there in the table on the right hand side, quote 1 and quote 2. The first one is a blue collar worker workforce. There's a bit more members, less assets, and lower average salaries. And then the other quote is for white collar, where you have fewer members with higher assets at commencement and higher average salaries, worth exactly the same gross employer and member contributions. Another portion of the RSC disclosure is the RSC Ranges. That allows for or highlights the impact of the admin fee charging method, and it is dependent on the annual salary and the member share at commencement. So that is based on a sample member, age 30, and a 10-year RSC term. And you'll see there in that table for the different charging methods, the impact it will have when you have an increase in the member share or an increase in salaries. So higher salaries compared to the different charging methods. I want to get to the quote sections and allow us a few minutes for questions as well. So looking at the quote 1 for the blue collar workers, the fees ranges from 0.8% to 2.4% with an average of 1.7%. The individual fund responses is included in the survey report, although anonymous. And you'll see there that the biggest portion is the purple part of the bar, and that is the investment charge. So if we exclude the investment charge, we see that it ranges all the way from 0.13% to 1% with an average of 0.6%. And interesting to note that the minimum one there purely charges other fee. So they didn't disclose it as an administration or advice fee. Or they maybe don't ask any advice and administration fees and only ask costs for other fees. So this is for our blue collar workers. So doing the same for the white collar, and we compare the two as well later on. Over a 10-year term, the RSC cost ranges from 0.7% to 2.1% with an average of 1.2%. As I said earlier, this is not a percentage of salary, so it's not something that we use to know and understand, but it's a percentage of the projected assets, but at least it's comparable between the funds. Once again, and even more than for the first quote, the investment charge is the biggest part of that. So excluding that, we see that for the white collar workers, the quote ranged from 0.04%, which is very close to 0, up to only 0.25% with an average of 0.15%. So comparing all 4 graphs for quote 1 and quote 2, you'll see that, and I'll also use the same scale there on the y-axis, the investment charge is by far the biggest portion of costs. And yeah, that ties in with what Colin said. Cost is important for what you want to get out of the fund. So do you want to pay for all these extra bells and whistles of investment choice, etc., if it's not necessary or will not be used by your members? And you'll see that on the right-hand side there, how much lower the costs are, right bottom side, for the blue collar or the white collar workers, which is basically just due to higher salaries and the higher starting member share or fund credits of the members at commencement. So just to conclude, the investment management charge makes up about 35 to 90% of the total RSC for the respondents. And once again, this RSC costs is not comparable between employers. So you can't take the RSC quote for one employer and compare that to the RSC quote for another employer, since it is driven by asset value. Some funds charge either no admin or advice or other fees. So it seems that the fees are bulked into one of those categories. And some of the respondents commented that advice fees was excluded as it is an employer cost and not a fund cost or a participating employer cost. So in conclusion, the RSC is a very useful tool for a specific employer to compare providers, but it's very important to consider the impact of the charging method on the individual members, that being the rand per member per month, or a percentage of salary, or sometimes a combination of the different charging methods. I think we still have a few minutes for questions. You'll see there on that slide before I hand over to Tommy to take us through any questions that there might be. Our email address, umbrellasurvey@sngargen.com, or you can visit our website and get the report there, as well as our contact details, umbrellafundsurvey.co.za. Tommy, I'll hand back to you to take us through any questions, if there are any questions in the chat box.
Thanks, Gia. Thanks to everybody for the presentation. I hope it was useful to everybody that is on the call. Got one question here. From Mervyn. Says it would be, thanks for the presentation, very good to see a comparison of returns per umbrella fund. Maybe complex to get this information, and also then whether the returns are expressed net of fees or gross of fees. So here, did you look at any investment return numbers?
Yes, yeah, that's something that we wanted to do, but as Mervyn said, it's complex to get this information. So that's definitely something that we'll look at for future surveys, is to look at the investment returns of specifically the default portfolios, and then, as Mervyn mentioned, to note whether it's gross or net returns. Because I think that will also give us an indication if we can compare that to the RSC portion for investment charges. If it makes sense to pay these higher charges in a specific fund, does that work with the higher returns that you can expect or not?
Yeah. And I think there are investment numbers available in the market in general, but I think what you mentioned, the default portfolios, and also whether there's something that's sort of locked in with the umbrella, that's sort of going to be the interesting information to get. Mo asked, you did not see Old Mutual on the list of participants? Yes, they elected not to participate. We're hoping that this survey generates some trust amongst everybody to say that this is really just a snapshot. So Old Mutual didn't participate in the survey for this one.
Tom, I could just add, we received responses from 8 of the 10 biggest funds, looking at the fund size in terms of membership and assets. So there's only 2 that didn't participate this round. So we hope that they will participate in future. And then some of the other smaller ones. So we're confident that it gives a good reflection of what is available in the markets.
Thanks, yeah. Neil asked, are the investment fees in the survey total TICs, total investment charges?
It should be. It should be based on the RSC disclosure standard. So that should include the TIC. It's the total expense ratio plus the transaction cost. So the cost that's included in the RSC should be the total investment charge.
Thanks. Here, Mervyn also makes a comment to say, please also survey if all umbrellas are offering passive investments and what the uptake is. That's going to be a useful one. I think as the passive investment start catching up and taking ground. That's going to be an interesting question to answer.
Tommy, and yeah, we really appreciate feedback from everyone that participated in the survey to tell us what we can do better and include next time around. What is maybe their distinguishing factors that we can look at and include in the survey. I think we'll just make it that much more useful for all the stakeholders.
Yeah. The question say, who is the second non-participant? Now, I think Mitchell is quite easy because it's one of the big ones that's not participating. I think we should keep confidence if possible. I don't know if it's possible from the data to see who the second one was.
I don't have the name in front of me right now, but we will. Anyone will probably be able to deduce it from the information provided, the list of participants, and then just the information from the FSCA database.
Question sort of slow down a bit. So, and I see we did reach 12 o'clock, so you may be wanting to download the survey from the website. Just in closing, I want to say thank you firstly to the panelists. Thanks for your time, both in presenting today, but also in preparing your sections of the report and analysing the data. Thanks for everybody who participated again, and also today for you attending. We appreciate it, and we look forward to your feedback as to how we can improve this in the future. So thanks so much, and I hope you have a very good day forward. Bye-bye.